Picture this. The U.S. Treasury quietly dropped an announcement they likely hoped would go unnoticed. The Federal Reserve has snapped up nearly $100 billion in Treasury bills in just 8 weeks. Wall Street, of course, hails this as fantastic news, claiming it keeps the financial system humming. But here's what they're not sharing. This very strategy has toppled currencies throughout history, and this move reveals just how trapped the Fed really is. Welcome to the few who prioritize facts over headlines. Listen carefully. What I am about to reveal isn't speculation. It's arithmetic certainty. Where are you witnessing this market fracture from? New York, London, Singapore? Drop your location in the comments. Let's dissect what they're selling. This week, the financial media framed the Fed's $90 billion Treasury bill purchases as technical operations, assuring smooth money market functioning. Then Treasury Secretary boasted that bond volatility is at a 5-year low. Nothing to worry about. Everything is stable. Go back to sleep. But here's what they won't admit. The Federal Reserve faces a $6.5 trillion dilemma on its balance sheet. Recall when they pledged quantitative tightening? They promised to unwind 2020's emergency spending and reduce assets. They cut it from $9 trillion at its peak down to $6.5 trillion, then they hit a wall. The system is so entrenched in debt, patched over with paper fixes, that shrinking the balance sheet any further would spark a liquidity crisis. Everything started freezing. Now, after a $2.5 trillion reduction, they're expanding again. This is troubling because it isn't like prior expansions. They're beginning from an already elevated balance sheet. For perspective, during the 2008 financial crisis, the Fed's balance sheet was roughly $900 billion. Today, it stands at $6.5 trillion. Yet the Fed and media cheerleaders spin cartwheels, insisting this isn't quantitative easing. They argue it's short-term debt, technical operations, so it's not money printing. Let's call it what it is: monetary intervention. A financial system dependent on central bank life support is neither stable nor sustainable. Imagine maxing out a credit card, opening another, and shuffling balances around. Has your financial health improved? Are you securing long-term stability? Or is it all smoke and mirrors? Keep piling on debt, keep spending, the situation only deteriorates. That's exactly where we are now. The Fed and elites have been kicking the can down the road, but you can only kick it so far. Here's where it gets alarming. Beyond expanding from a higher starting point, the U.S. faces $9 trillion that must be refinanced at today's elevated rates. Add an estimated $2 trillion in new debt this year, $11 trillion that must find buyers. Who will buy it? China is net selling. Japan, the largest foreign holder, is pulling back. Capital is returning home, fast. Foreign appetite for U.S. debt is declining. That $90 billion in short-term bills might sound trivial today, but I'm focused on the $11 trillion looming ahead. If the Fed doesn't intervene, interest rates will spike, and the entire Ponzi structure will unravel. So when intervention comes, what does it mean for you, your dollars, savings, retirement? History gives the answer. Currency collapses, from Weimar Germany to Venezuela, follow predictable patterns. Governments unable to fund themselves lead central banks to print currency, eroding trust. Institutional smart money seeks tangible stores of value, which explains surging physical gold demand. Zoom out, the dollar has lost 30% of its purchasing power in recent years. Gold's price tells a contrasting story. Which asset preserves wealth? Smart money answers clearly. If the U.S. were truly prosperous, stable, secure, the Fed wouldn't be stepping in. Things aren't stable. They're artificial, propped up, a snake devouring its tail. Let's break down what this means for you. First, when they say rates are stable, volatility is low, that is manufactured stability. It signals market manipulation, not a thriving economy. Second, printing more currency dilutes existing units, basic math. Inflation is inevitable. Third, the Fed couldn't shrink below $6.5 trillion before restarting expansion. Many debate the next Fed chair. Reduce the balance sheet? Good luck. The math is unforgiving. Shrink too much, liquidity crisis. Expand, hello, inflation. Media cheerleaders will spin stability, temporary, business as usual. The reality, massive monetary intervention looms, threatening savings, dollars, retirement. Even if numbers on screen remain static, a 30% loss of purchasing power hits hard. That's why those preparing are securing physical gold and silver. Forget digital illusions. Let's return to tangible reality: scarcity, physics, chemistry. Wall Street ignores the disconnect between paper prices and real value. Proof? Look at your pantry. Chips mostly air. Detergent reduced in weight, but same price. Corporations call it package optimization. I call it theft of purchasing power. $5 bought a meal 5 years ago. Now $50 for the same burger and fries. Housing? In 1970, 3 years' work bought a house. Today, couples toil 30 years for the same property. Your lifetime is being stolen. Where is smart money flowing? Into assets that can't be printed: industrial gold and silver. Modern technology, AI data centers, advanced microchips, depends on them. Electric vehicles, solar energy, all demand vast silver quantities. Mining cannot keep pace. Geopolitics amplifies demand. Defense systems, satellites, missiles, all need gold and silver. Price is irrelevant. Supply is finite. COMEX and London vaults are being depleted. Premiums are soaring, delivery times stretching. Paper markets misrepresent reality. Gold cannot be printed. The Fed can create $1 trillion digitally in hours. Gold requires decades of exploration and development. Consider your portfolio. Do you hold depreciating paper or finite essential assets? 11 trillion chasing limited real assets. Direction is one way: up. Now, the final act. The Fed faces 3 doors. Door 1, the Volcker fantasy. Act responsibly, raise rates, refuse to print for $11 trillion debt. Outcome? Government bankruptcy, housing collapse, stock market halving overnight. Politicians will never allow it. Door 2, the inflationary inferno. Fed prints to cover shortfall, yield curve control, balance sheet stabilization, branding masks debasement. Numbers may stay, but everyday prices explode. Paper millionaires, real poverty. Door 3, Orwellian reset. Dollar loses reserve status. Central planners introduce digital currency. Programmable money, expiring cash. Science fiction? No, reality under construction. Knowing this, what's your strategy? Don't wait for anchors to sound alarm. They'll be too late. Act now. Secure your labor. Freeze its energy into tangible assets: gold, silver, land, commodities. Real assets require no counterparty. Gold owes nothing. Bonds, dollars, debts. Gold? It simply exists. Most will sleepwalk into disaster. You're still here. Resistance. Observe, prepare, survive. I'm a forensic analyst. The crime scene shows your purchasing power is at risk. Don't navigate alone. Link below provides full dossier, strategy consultation. Study it. Knowledge will save you from costly ignorance. Trust metal, trust history. And if you want more sharp updates like this on boring currency, subscribe and comment boring currency so I know you're part of the community. This video is for education and discussion only. I'm not your financial advisor. I don't know your personal situation, and nothing here is a buy or sell recommendation. Do your own research and think for yourself. Stay safe.